Hello and welcome to another episode of Your Retirement Planning Simplified. I am Joe Curry, along with my co-host, as always, Lindsay Wilson. How are you, Lindsay?
I'm great, Joe. It's a lovely spring day here and enjoying the nice weather. How are you?
I'm good, thanks. We got a jammed day with podcast recording, and then I'm hoping that I might even get out golfing this afternoon. We'll see.
Hey, fantastic.
Yeah, I think with all the kids' sports and everything, that golfing is not going to be a regular activity for me now, unfortunately. But
Oh,
it's all right. The kids' stuff's fun too, and then it'll only last for a little while. As everyone reminds me, it goes by quick. So.
yes, for sure. For sure. So today we have Kaz Nesbitt on the show.
Yeah, so Kaz has been on the show before, and he is he's a tax specialist with Grant Thornton. He is wealth of knowledge around tax planning. We have a lot of clients we work with together, and he's always someone I go to when I have complicated tax questions. So it's great to have him on the show today. We are talking about the new, or at least the proposed, capital gain inclusion rate increase coming up on June 25th, 2024. And I will just mention, Lindsay, that we're recording this on, May 16th, 2024. So things could change between now and whenever someone might listen to this. So I just want to make sure I get that on there. But anyway, yeah, we just talked about kind of what are capital gains, what's an inclusion rate, what do the changes mean, who do they affect, potential strategies, things to think about. So anyway, yeah, it's a lot of good info from Kaz on this.
Excellent. Well, Kaz is a partner at Grant Thornton. He is a CPA. That's right, Joe, right? He's a CPA? Yeah,
He's a
okay. He's
CPA,
a
yeah.
CPA. As a partner in domestic income tax, he works with business owners, high net worth individuals, and estates to navigate complex income tax systems and minimize tax burden. He also advises corporate clients on transactions, such as incorporations and sales of businesses, to optimize their current objectives and provide them with flexibility as their businesses and goals evolve. He's also takes a holistic approach to achieving client objectives, and he often collaborates with assurance and advisory teams as well as legal and financial advisors.
Yeah, Kaz is a great resource for so any of our listeners who are getting close to retirement and own a business and wanting to make sure they're kind of maximizing that that like a saving on tax. I mean, that's kind of what Kaz does. But anyway, so with that, Lindsay, I think we can jump right into it.
Sounds great.
All right, Kaz, welcome to the show. How are you today?
I'm great. Thanks for having me, Joe. How are you?
I'm good, thanks. Excited to talk about taxes, everyone's most favorite topic. um,
Absolutely.
but there's some changes coming up. We think there's some changes coming up. Things were announced in the budget, so I wanted to have you on, being a tax expert, to just talk about some of these changes, how they might affect our listeners specifically, and just maybe what people should be doing about it. So I thought maybe where we could start is just jumping into what are capital gains, because that's kind of the changes are capital gains, or two capital gain rates. So maybe just start with what are capital gains and how are they taxed?
Yeah, absolutely. So, capital gains occur when someone invests in a capital property. So, this could be marketable securities, real estate, and it generally occurs when that's not the main desire is to earn the income from the property. So, if it's like, let's liken it to, say, marketable securities, where the main intention might be to earn income from dividends or interest, etc. But if you dispose of that property, it's the increase in value when you dispose of that property. So if you go in with the intention of earning the income from disposing of the property, it could be classified as business income. Whereas if you dispose of the property, and that's kind of not the primary use of the property, it's kind of you dispose of it later, the increase in value is a capital gain. Or if it decreases in value, it's considered a capital loss.
Okay. And for our listeners, so we could be talking about stocks, and you say marketable securities. We could also be talking about real estate. So there's kind of some different categories that could come up, right?
Absolutely. Even personal use property as well. So, I mean, if you had a vehicle that increased in value, perhaps that could be a capital gain as well. If you didn't purchase it for the purpose of selling it, or if you have a collection, it could be art, it could be musical instruments, it could be jewelry as well. Capital gains could occur if it increases in value.
Right. Okay. So what is the capital gains inclusion rate, and why is that important for taxpayers and investors to understand?
Yeah, no, that's a great question. So, capital gains have a preferred tax treatment in Canada, and that's based off the inclusion rate. So Canada has a graduated tax rate system based off the amount of income you have. It helps determine the amount of tax that you would otherwise have to pay. But capital gains are a bit of an incentive to invest. So there's a preferred tax treatment, and that's by factoring the capital gain added inclusion rate. So right now, the inclusion rate, subject to any changes coming up here as announced, is 50%. So that means if you incur a capital gain of, let's say, $100, it's included in your regular income at $50 based off that 50% inclusion rate. So it gets a preferred tax treatment. And then that $50 is taxed at your regular marginal tax rate.
Okay. Now, there's some, and again, the reason we're talking today is some of the proposed changes in the 2024 budget. So the budget, first we'll talk about businesses or corporations, and then we'll talk about individuals. So the 2024 budget proposes increasing the capital gains inclusion rate from 50 to 66 and a third percent for corporations and trusts. So could you explain what that means to us in kind of practical terms?
Yeah, absolutely. I think the best way is to work through with an example. So basically, to start off, the taxation of capital gains, it is going to be taxed a little bit heavier going forward, particular for corporations and trusts. So let's work through that same example of a $100 capital gain. You purchase property, you sell it for $100 more than you purchased it for. There's a $100 capital gain. Under the current legislation, that would be $50 included in income. But going forward, that would be $66.67 included in income, taxed at the regular tax rate. So for corporations and trusts, that tends to be a fairly high tax rate to begin with. So there's a larger portion of the gain is now subject to tax compared to before.
Okay. And if we look at an individual, so there's some changes here too. So it's the same change in the inclusion rate, but there's a threshold. Could you speak a little bit about that?
Yeah, that's right. So there's a safe harbor that they've announced of $250,000. So what's been announced is that capital gains up to $250,000 for individuals are still subject to the 50% inclusion rate. And that's on an annual basis. No announcement so far about it being indexed. So that's each year, the first $250,000 of capital gains incurred would be subject to a 50% inclusion rate. And incrementally, any capital gains in excess of $250,000 would be subject to the new 66.67% inclusion rate.
Okay. So if we think about the impact on taxpayers, could you maybe talk a little bit about who might be most impacted by these changes? And if you can think of any, can you maybe give us an example of a typical scenario that might come up, one for, say, a retiree and one for, say, a business owner?
Yeah, for sure. Let's dig into business owners or corporations first, because they're probably more directly impacted on a regular basis. So corporations that have accrued investments, and in particular, I would say professional corporations are seeing a lot of that, where they have a portfolio of investments or marketable securities that each year there's annual trades, capital gains are realized as perhaps as the portfolio is liquidated, as they start to wind up the corporation, or even just on the rebalancing of the portfolio. Could be distribution of capital gains from the investments that are made, or it could be the sale or reshuffling of funds. So on an annual basis, they're now going to see that tax hit a little bit heavier at that higher inclusion rate, and that's going to hit all capital gains. Whereas individuals, it's going to be a little bit larger capital gain before they're impacted. Not as many taxpayers directly on a day-to-day basis are going to be hit by the new inclusion rate because it requires capital gains in excess of $250,000. But there are particular scenarios where I foresee it coming up, whether it's intended or unintended. It's going to be properties, for example, like secondary properties. Generally speaking, there's a principal residence exemption in Canada. So properties that are covered by your principal residence exemption are not subject to capital gains tax and not subject to this limit. But if you had a secondary property or piece of real estate, it could even be a rental property, not subject to the principal residence exemption. There is a good chance with the real estate market and the economy over the past few years that there is a large accrued capital gain. So they might be subject to this new inclusion rate and more tax than they'd anticipated, particularly if it's a property that's been in the family or that they've owned for several years. The other piece is on death as well. I think when I chatted with you a few years ago, we talked about tax impact at death, and there's a deemed disposition of all your assets when you pass away. So that could hit in terms of real estate or non-registered investment portfolios as well. as the investments, as the real estate increases value over time, there's an accrued capital gain. And on death, you're deemed to dispose of all your assets and subject to capital gains tax at that time. So there's a much larger chance that when someone passes away and they're deemed to dispose of their assets, that there could be a capital gain in excess of $250,000, and as such, subject to a higher rate of tax now.
Okay. Now, I'm probably wrong on this number. I think it was somewhere, though, Justin Trudeau had mentioned something like only 0.13% of Canadians being affected. Does that number sound right?
That does sound like the number that he announced. Yes. And
yes.
I don't know if that's supported or where the facts on that are. I would certainly say there's a number of my clients that I deal with that are going to be impacted by it. And it could just be the market that I'm in or the client base I have, but it feels like a lot more than 0.13%. We've been getting a lot of calls from our clients that are going to see some kind of impact on it and have been trying to address it.
Yeah. So that's kind of what I was going to ask you is kind of, obviously that number has been thrown out by him, I think multiple times. And I was just curious to kind of your thoughts on whether that's a realistic number or if that's supported, but I think you kind of addressed it already.
Yeah.
Okay. So are there any types or what types of assets or investments do you think might be impacted from the new inclusion rate? Do you have any thoughts on that?
I think most significantly, at least at the individual level, I think real estate's going to be most impacted by it. At the corporate level, I think it's really anything. I think corporations that hold real estate for sure are probably going to be impacted by it, assuming that real estate continues to go up in value or has gone up in value to date or has gone up at the time of sale. But I think your regular non-registered investment portfolio are going to be hit pretty hard when it's inside a corporation or a trust as well. And I didn't go too far into trusts, and I will dig into that a little bit just for an additional comment.
Sure, yeah.
In the original announcement, they did indicate that where capital gains are flowed through a partnership or trust, so they're allocated out of the trust or out of the partnership, then it would be subject to the individual's $250,000 annual limit. So again, we haven't seen any legislation on this. We don't know what it's going to look like. We don't know if there's going to be any further carve-outs or anything like that, but perhaps not as directly impacted by this on the trust side of things. Again, subject to allocating the gains out of the trust. If the trust is set up there's a variety of reasons for trust, and I won't go too deep into that, but if on an annual basis that the trust is paying the tax on capital gains, it will be impacted as well on, again, I'm foreseeing it mostly on the side of real estate and marketable securities. But again, more at the trust or corporate level, it's going to be more on the day-to-day shuffling around your portfolio, and on the individual level, again, more on a disposition of real estate at a larger scale. Okay.
Now, I think some of our listeners are probably wondering, okay, should I be doing something about this? So what do you think should investors and business owners be taking any specific actions now in anticipation of these changes? And if so, what kind of strategies might they be thinking about?
Yeah, that's a great question. And it really does depend. I think action should be taken in at least doing an assessment of how they might be impacted by it. As I mentioned, it was an announcement. We haven't seen any legislation on this yet, but we are planning as if it is going to be enacted on June 25th. It said on or after June 25th was the date that was provided in the budget. So what we've been doing with our clients is an assessment. Do you have large accrued capital gains? And what was your plan for that? I think with anything, you have to think of the big picture, and you don't necessarily want the tax impact to drive your decision making. So you have to consider, what is the impact if you realize the capital gains now? If you are to realize the capital gains because you think the inclusion rate's going up, you think that's going to impact you, you do the assessment. What would the tax be today at the current inclusion rate? What would the tax be at the future? And if you decide, okay, here's what our tax difference is, do we want to pay the tax now? And then you have to look at the time value of money on that. So that means if you're paying the tax, that's money you don't have in your pocket anymore, and it's no longer earning a rate of return. So we have done a bit of an assessment on that, looking at kind of what the rate of return would be, or which should be required in order for that to make sense, and kind of what the time period looks like. If the capital gain was otherwise going to be realized in the next 2 or so years, we're kind of seeing rates of about 15.5%. You need to get a rate better than that for it to make sense not to prepay the capital gains. If you're looking 5 to 7 years out, as long as you're comfortable that you might see a rate of return of at least 5%, 5+%, then you really have to weigh your odds there. And then beyond that, the rate of return you would have to get for it to make sense to prepay the tax is quite low. We're getting down on the 10 years around 3%, 15 years about 2%. So if they weren't otherwise thinking about liquidating that real estate, or if they're not liquidating their company, you really have to look at, okay, what is our time horizon? Does it make sense to prepay this? But if you're already planning for it, I guess my opinion is whether or not this goes through as planned or when it goes through, capital gains rates probably aren't going down. So if you're planning on realizing capital gains anyways, we know what the rate is today. So it might be worth revisiting your estate plan at this stage and seeing if there is any preemptive measures you might want to take.
Okay. Well said. Thanks, Kaz. So if we kind of evaluate these changes that are being proposed, what are the potential benefits and drawbacks of increasing the capital gains inclusion rate from the government's perspective and from the taxpayer's perspective? Any thoughts on that?
Yeah, for sure. I guess I'll stick to some of the budget announcements and some of the expectations on it. And I think the general thought is that it is going to generate more income tax revenue as people are paying larger amounts of tax on their capital gains. It should generally generate more revenue for the government. I think particularly in the early years, they have budgeted a large increase of tax revenue as a result of this change, particularly in the first year. Probably on the basis that people might be preemptively recognizing their capital gains prior to this change and over the next little bit. But over time, they might slow down and not, and then kind of even out. But it is an expectation probably that the higher the tax rate, the more tax revenue generated, because ultimately capital gains are going to be realized when your investments are liquidated. So that would be the reason, I guess, that the benefit to the government. I think from an overall policy perspective and generally thinking, and perhaps the drawbacks are that capital gains are taxed at a favorable rate to incentivize investment in the country and incentivize investment in businesses. So we talked about marketable securities, but you could have a capital gain simply from investing in a private corporation as well. As that corporation goes up in value and you go to sell the business, you might incur a capital gain there, whether it's on a sale of assets or a sale of shares. So a little bit of a disincentive there to invest in capital if the tax rate isn't quite so favorable. That being said, before I go away from that point, along in the budget too, they did also announce a increase to the lifetime capital gains exemption, which is a sale of qualified small business corporation shares. Historically, it's been indexed to inflation. It was just over $1 million, about $1,016,000 for 2024. They've announced that that's going up to $1.25 million to kind of counter that investment incentive. But again, that has to be balanced with, okay, that portion might be free of capital gains tax, but there are other things to think about too. Recent announcements to changes to alternative minimum tax, which maybe I'll circle back to that point in a second. And then the capital gains exemption, sure, there might be more exempt value, but if the value of the business you're selling, for example, is above and beyond that 1.25 million, that excess amount could now be taxed at a higher rate. So you do have to balance that. We have a couple clients that are in the midst of a sale right now, and it's, do we push forward that sale prior to June 25th to close it because of the current capital gains inclusion rate? Or do we delay it so we get more lifetime capital gains exemption? And in some of those scenarios, the value is so much higher that despite getting extra lifetime capital gains exemption, that the higher inclusion rate is actually a bit of a disincentive. So it might make sense to push forward the sale. So I really think that's the drawback on it, is that incentive to invest in Canada realistically.
Yeah, no, I'd agree 100%. Now, there's always some uncertainty with proposed budget changes. We've seen some other things maybe not go through the way we thought they were going to recently, such as like Bear Trust or underutilized housing tax. But how likely do you think these changes are to be implemented as proposed? And what are the chances that they're modified before, actually taking place, or just not taking place at all, I guess?
Yeah, no, that's a great question. I don't know that I can give a percentage likelihood on it, but I have seen some factors kind of that make me think about it, absolutely. And as you indicated there have been a couple announcements over the course of the last couple of years that have incentivized certain actions, like filing Bear Trust returns, for example, or the underused housing tax, which kind of got pulled back because it might have been a little wider reaching than expected. There have been other announcements over the last few years too, even on intergenerational business transfers, where some rules rolled out and a couple months later the government decided that the rules weren't quite as they wanted. They might have been a little bit farther reaching than they desired. So they were going to make some changes, and they announced that those changes would be made the earlier of November 2021 and the implementation date or the later thereof. And those still haven't been implemented. A lot of announcements that have been, again, announced, even some that are partially through Parliament that haven't passed yet. And I know there has been a lot of pushback on the capital gains inclusion rate for a variety of reasons, the extra tax, the disincentive to invest, but also the concept of corporate integration as well, or taxation integration. So generally speaking, the tax system has been designed so that income earned by an individual should largely mimic income earned by a corporation on a flow-through basis when it works its way through. But by having that safe harbor of $250,000 on the individual level and not on a corporate level, the concept of integration doesn't quite work out. So I know there have been some submissions to try and address some of these rules, to try and address some of the transitional relief. So I'm not sure if it'll go through when or how it was announced. I think it is, we are planning as if it will, but there might be some modifications still to come. There might be some delays still to come. So it's certainly worth evaluating the big picture. But even in doing so, the one thing I mentioned before as well, which again is part of that announcements that haven't quite passed legislation, is the concept of alternative minimum tax. And that was an announcement last year. And that's kind of a secondary calculation of tax for someone beyond the regular tax system. Certain favorable tax attributes, some tax credits, sources of income are taxed differently under this alternative system so that the taxpayer is paying a certain level of tax. So for capital gains purposes, again, right now the inclusion rate's 50%. It could go up to 66.67% on the next 250,000. But for the purposes of calculating alternative minimum tax, capital gains are included in income at 100% inclusion rate. So by prepaying some of the capital gains tax, taxpayers could be walking into a situation where they have to pay this alternative minimum tax, which, depending on future sources of income, could be recovered, but perhaps not. And that's just another interesting one that had been previously announced and to be effective January 1st, 2024, the new measures on that. And that's another one that the legislation hasn't fully passed on. So we are navigating a couple pieces of proposed legislation when we do some planning around this stuff.
Seems a bit like, if everything goes through, almost a bit like a tax trap in a way.
It kind of feels that way.
Okay. So for our listeners who are retirees or business owners, if you just kind of had to sum up some advice for them in light of these proposed changes, and any other specific resources or professional services that you think they should be talking to, how would you wrap that all up?
Yeah, absolutely. I think the biggest thing is you always want to begin with the end in mind as much as possible, and to think, what does the big picture look like? What is your plan, regardless of any current changes, proposed changes, etc.? What is your estate plan, your retirement plan, etc.? What does your time horizon look like? And start from there. I don't think you should let the tax measures themselves push things forward. But that being said, once you have sort of the end in mind, what does that time horizon look like? I think it is always important in retirement and estate planning for retirees, for business owners, etc., to have kind of that picture. What is that terminal tax liability? If they were to pass away today, what does that look like? And then when you have that, you can back into, okay, what does it look like under the current measures? What does that look like under future measures? And then how does that play into if these changes go through as incurred? If that's a short-term plan, that there were going to be some capital gains realized in your overall plan, maybe it is worthwhile in investigating whether any action should be taken. But again, you have to think about the rate of return, the time horizon, and what is the big picture. And I'd say you should probably work with your financial planner, your accountant. And I mean, in doing so, maybe you want to review your wills as well, just to see the big picture. What's the impact of this, and how can you navigate around it?
That's perfect. Anything else you'd like to add in light of the kind of the proposed changes around the capital gains inclusion rate?
I would just say approach with caution, as you do with anything. I think these are big, significant changes, but again, they are proposed at this stage, and I think it could be detrimental to take immediate action without thinking about it. I think the quick thought is liquidate everything, pay tax based off today's rates, but how does that really play into the big picture? I just say sit back, think about it. Let's see if anything further comes out, but maybe not wait to the last minute, but get going on what the big picture looks like, and just view it from that standpoint.
Okay, awesome. Thanks, Kaz. So to all of our listeners, Kaz is a key resource for me and many of our clients around tax planning. So, Kaz, if people want to follow you, see what you're up to, I know you've been putting out some content and giving some case studies, things like that. How can people get in touch, and where can they follow you?
Yeah, absolutely, Joe. I think that probably the best way is to follow me on LinkedIn. I try and provide some relevant topics, some situations, some things to think about. You can probably connect with me there and go from there.
Perfect. Well, thanks for joining us, Kaz. Appreciate all your insights today.
Awesome. Thanks, Joe.
Thank you for joining us for this latest episode of Your Retirement Planning Simplified. Be sure to tune back in for the next episode. And until then, we're here to help you simplify and succeed in your retirement planning.